Good afternoon, guys. So when it come to the yesterday class, we just provided an overview regarding to the approaches, right? It's not a detailed discussion; it's just an overview. Okay, then fine. First thing, do you understand what is the mean for optimum capital structure? Optimum capital structure. Optimum capital structure. What? Best mix. In simple, best mix of capital composition. How you say that is a best? We can't say based on overview. We are saying based on some parameters. What are the parameters we have, Nana? Ownership point of view, risk point of view, these two are theory points. Apart from the theory, we are using problematic 4 things, but I recorded only 3 here. So KO point of view, MPS point of view, EPS point of view, one more thing is there, market value of firm also. MPS is nothing but market value of firm, that's why I am not written here. MPS talks about per share point of view, market value of firm talks about total. Nana, clear Nana? But write it that point also. What you want, maximum market value or a minimum market value? So if you are composing mix means you want maximum market value. Based on these parameters only, we will decide that mix is a best or not. If it is a best, we are using a name called optimum capital structure. Hope you guys clear? Okay, then fine. Next, when it comes to, there is a discussion of approaches. So there is a discussion of approaches. Here approaches are classified into 2 types: relevance approaches, irrelevance approaches. What is the mean for relevance, Nana? If mix changes, market value of firm also changes. What is meant for irrelevant approaches, Nana? Even though mix changes, market value remains constant. For proving that statements, they provided concepts called net income approach, traditional approach for relevance approaches, net operating income approach, and Modigliani-Miller approach for irrelevance approaches. Nana, clear? Okay, then fine. When it comes to the first discussion, net income approach. So that income approach said by David Durand, Nana. Are you okay? These all are purely assumption based approaches. So purely assumption based approaches. Point to be understood. Clear now? Okay, then fine. Now what he said means, simple point they said, Nana, in a market there is only 2 sources of funds. What are the 2 sources? Equity, debt. Okay, then fine. Next assumption they taken, debt is cheaper than equity. So debt is cheaper than equity. Reasons also is there. Not only assumption, reasons also there. Tax advantage is there for KD or KE. Yes or no? No? That's why KE is more than the KD, or KD is less than the KE. Clear? Okay. Next assumption they taken, Nana, guaranteed EBIT. Guaranteed EBIT. What does it mean for guaranteed EBIT? If company do an operation, there is a mandatory EBIT profit. Is it practically possible? But that's why they taken as an assumption. Okay, then fine. Next, the next assumption they taken, perpetual life. This is a common assumption we are followed as per accounts. Next point, Nana, 100% payout ratio. They are not holding retains. But when come to the practicality, companies will hold the retains. But their assumption 100% payout. If you follow this assumption only, the theory will be works, Nana. The next assumption, I think this point not there, please record. KE remains constant. Page number 172. Page number 172. At this point, KE remains constant. Okay, then fine. I will explain why KE also constant. Now David Durand says that in a market, debt is a cheaper fund. Debt is a cheaper fund. If you rises, cheaper represent KD low only, na? Because of low KD, your KO decreases. What is the KO? overall cost of capital. If your overall cost of capital decreases due to capitalization, your market value of firm what happen? Increases. That is a concept I said, EBAD divided by KO. Nana clear Nana? Because of mix changing, what you are procuring? Debt only, na? That means mix changes, mix changes, market value of firm also what happen? Changes. That sentence proved? Sir, clear, sir? Now, for that theory, they provided calculation part also, Nana. So here, the calculation agenda is calculating market value of the firm. Market value of the firm. You can calculate in two ways, Nana. One is capitalization concept. Overall profit divided by overall cost of capital. One point I said clearly. What that point, Nana? Contribution is also be known as variable profit. EBAD is also be known as business profit or operating profit. EBD is known as taxable profit. EAT is known as net profit or net income. Sir, clear, sir? So, if you want to calculate overall value, you need to consider what profit? Overall profit only. What's the overall profit here? EBAT, na? Divided with KE or KD or KO. Why KO? Overall. Hope you guys clear. Okay, then fine. There is another alternative, Nana. In company, there is two sources of funds. Equity fund, debt fund. Some of the two also be known as organization value. That is called market value of equity plus market value of debt. So some student had a doubt, sir, preference is there now. No, there is assumption. Only two sources of funds. Only two sources of funds. Clear, ma? Okay, then fine. How to calculate market value of equity? Here also we are using capitalization model only. What earnings is a numerator? EBAT or EBT or EAT? No, EAESH. Sir, clear, sir? Can I name it as EAESH is nothing but PAT? Why? No preference share capital. If there is a no preference share capital, there is a no deduction of preference dividend. PAT is nothing but EAESH. But ultimately we need to use what name? EAESH. Clear? Now can I divide it with KO? Why? It is particularly equity related. KE. Next, when it comes to the debt calculation, interest divided by KD. Hope you guys clear? Okay, then fine. Now when it comes to, if you want add this in notes, income statement. Sales minus variable cost. You will get what, Nana? Contribution. On that contribution, you have to remove operating fixed cost. Includes interest, excludes interest. Excludes interest. Interest is a fixed cost, but the fixed cost has a two definition: operating fixed cost and finance fixed cost. If you remove operating fixed cost, the profit you will get is known as EBIT. On that EBIT, you have to remove now finance fixed cost called interest. Then what you will get, Nana? EBT. On that EBT, you have to remove tax. Then you will get what, Nana? EAT. Minus preference dividend, if any is there. But for approaches, preference dividend is not a concept. But I am saying total income statement. Okay? If you remove preference dividend, what you will get, Nana? EAESH. Why? Because for calculation you want EBT, for some calculation you want EAESH. That's why income statement is mandatory. Earning availability to equity shareholder. Clear? If you want on side, write down the alternative names also. So what about the alternate name for contribution? Variable profit. EBIT, operating profit. Or our business profit. EBT, taxable profit. EAT, net profit or our net income. So EASS you already know. Equity shareholder profit or owner's profit. Nana, clear, Nana? But when it comes to the problems, Nana, instead of statement, they're using shortcuts, Nana. They're using shortcut. Can I calculate like this? Sales minus variable cost, you will get contribution. Minus operating fixed cost, you will get EBIT. Minus interest, you will get EBITDA. Minus tax, you will get EAT. Minus preference dividend, you will get what, ma? EAESH. But when it comes to the problems, Nana, they will do like this: EBIT minus interest into 1 minus tax minus preference dividend. That equals to EAESH. This kind of shortcut also we can use. Sir, clear, sir? Any doubt on that shortcut, sir? Okay. But we learned like a formula, but when it comes to the problems point of view, we are not using formula calculation, we are using statements. We are using what, Nana? Statement. Now one more point, written or not here. Take another point. This basic point, Nana. No tax, ra. Assumption. No tax. No tax. Practically it works, Nana. No tax practically works, sir. Every organization need to pay tax if there is a EBT. If there is a EBIT, if there is a EBT. If there is a EBT. Yes or no, no? But this guy, David is there, na? He said no tax. He taken that assumption. But when come to the problems point of view, Nana, if you can take tax, not a problem. If you ignore tax, not a problem. Okay. In material, the solution is like a tax rate given in the question paper, but they not considered. When it comes to your notebook solution, I consider tax also. Both are correct only. In suggested answer also, they provided that kind of answers. Clear? Don't worry about that. Two different solutions. What is the reason behind that? No tax is a basic assumption. This theory propounded before 1930s, Nana. Income Tax Act came which year? Year. Clear? That's why they have followed that kind of assumptions. Now without tax we can't do anything. That's why we are rewriting the assumption. What is the rewriting the assumption? If there is a tax rate in the question paper, we can consider. Sir, clear, sir? It is not a subject issue, Nana. It is just a concept issue. Okay. What you follow, not a problem. You will get marks. With tax, marks. Without tax also, marks. Are you okay now? You have a doubt? Please put a note pointing down. As per David Durand assumption, no tax is a concept. If tax rate given in the question paper, consider not a problem. Hope you guys clear? Okay, then fine. Open illustration number 13, Nana. Illustration number 13, 1-3. Guys, tell me, are you understand the concept of net income approach? Clear? Assumptions are okay? Okay, then fine. Illustration number 13. Page number 78 in workbook, Nana. Page number 78 in workbook. Now see the question number 13, Nana. A limited, S limited are in the same risk class and similar in every aspect, Nana, not respect. There is aspect. Every aspect except that A limited is a levered firm while S limited is a unlevered. I hope you know the meaning of levered firm and unlevered firm. If company have a risk, that is called levered firm. If company don't have a risk, that is called unlevered firm. What is the risk here? Debt. If company having a mix of equity plus debt, that is called levered firm. If company having only equity, that is called unlevered firm. Now they're saying that in A limited, same in all aspects of S limited. But in one point they are differ. What is that one point, Nana? A limited is a levered firm. So A limited is a levered firm means what, Nana? Equity plus debt. What about the S limited? 100% equity. Okay. A limited has a 12 lakh debenture worth carrying a 12% rate of interest. Debt value? 12 lakh is a debt value. Okay. What about the rate of interest? 12%. Both the firms earn 18% before interest and tax on their total assets of 22 lakhs. This is a clue for EBAT calculation. Now what is the 18% before interest and tax? That is nothing but EBAT. Yeah? How to calculate this EBAT? 80% on 22 lakh of the assets. 3. For which company, Rana? Levered. Both of the companies, same in all aspects. Hope you guys clear. Okay, then fine. The tax rate is 50%. As David Duran says, what, Nana? No tax. But question paper, they use a tax rate. Okay. And the capitalization rate of 14% for the unlevered firm. Can I name it is called KE, Nana? Can I name it is called KO? If it is a 100% equity, K is nothing but what, Nana? KO. For levered firm, can I name it is called KO? No. There is a debt. There is a equity. Okay. Can I take this 14% KE for S limited? But they said unlevered firm, na? What is the first assumption we newly added? KE remains constant. KE remains what, Nana? Constant. Even though capital structure changes, KE remains constant. Hope you guys clear. Are you understand the logic behind this? Okay, then fine. Calculate the value of both the firms using net income approach. So generally we have a formulas, na? But we are not using formulas, we are using a statement kind of solution. Particulars. What about the first company? A, na? A limited, S limited. Here write it down properly, levered firm. This is a unlevered firm. If you change the firms also not a problem, ma. Okay. Now please tell me the EBAT. 22 lakhs into 18%. How much, ma? 3 lakh for both the companies. Huh? On that EBAT, you need to remove what, Nana? Interest. What is the rate they given, Nana? 12 lakh rupees into 12%. For A limited or both or S limited? Only A limited. How much, Nana? 1,44,000. Here nil. So what is the outcome, Nana? EBT. 2,52,000. What about here? 3,96,000 same. Now here only you need to take a call. With the tax or without tax. Hope you guys clear? As per real assumption, no tax. If question paper specifies, consider also not a problem. If you not consider also, not a problem. But in cmainter, suggested answer also they provided. If tax rate is given, they considered none. Clear? In a real world, tax is a it playing a key role. That's why that point of view they consider tax rate, even though there is an assumption. Less tax. What the rate they given, Nana? 50%. Answer? 1,26,000. What about here? 1,98,000. If you remove tax, you will get EAT. How much ma? 1,26,000. 1,98,000. Can I name it as EAD is nothing but EISH? Sir, clear sir? Now there is no preference dividend, no? Divided with KE. What about the KE? 14% for unlevered firm. Now what about the levered firm? Same. KE remains constant. Now if you divide with EASH divided by KE, you will get market value of firm, market value of equity. Now what about the market value of equity? 9 lakhs. What about here? 280. For this market value of equity, we are adding market value of debt. Then you will get what na market value of firm. How much na? 21 lakhs. 14 lakh. 14,286. ట్యాక్స్ తీసుకోలేదు ఆ పాయింట్ చెప్పా కూడా. దే ఆర్ నాట్ కన్సిడర్డ్ ట్యాక్స్ ఈవెన్ దే ఆర్ స్పెసిఫైడ్. ఓకే, యూ కెన్ గో అండ్ చెక్ ద నోట్స్. ఐ మెన్షన్ నోట్ పాయింట్. Notes. Sir, clearer sir? So even though we have a formula, we are using this kind of presentation, Nana. Any doubt on this calculation part? Clear? Sure? Okay, then fine, Nana. You can observe, if there is a no debt, market value of equity is nothing but what, Nana? Market value of firm. That is the logic we are using. KE is nothing but KO. Clear? Next. Net operating income approach is also be known as set of theory or offset theory. Set of theory or offset theory. I think overview given in yesterday class. So what is the overview I given for this net operating income approach, Nana? Here there is a no calculation part, ma. It is a theory concept. Okay, but one point you need to understand. This is the base for approach. This is a base for approach. Okay, entire theory will explain in net operating income, net operating income approach. Their practical portion explained in approach. Calculation part there in approach, not in net operating income approach. Nana, clear, Nana? Okay. Debt is a cheaper fund only, no? That is a cheaper fund. If you rises, are you get advantage or disadvantage? Low, KO decreases. KO decreases means advantage only, no? But there is a demerit on that net income approach. Why? Because David says that equity shareholders are dumb, they are not expecting anything, even though company facing a risk. Practically not possible. Practically it possible? No. That's why he revised again with the name called net operating income approach. This also said by that guy only, David Durant. Nana, clear, Nana? So what he identified means, if debt come into the company, debt is coming means risk also coming. So no one is face risk free of cost. Already existing owners is there, na? They are not ready to bear that risk. When they bear, if a company gives a extra expectation, at the time they will bear, na? Yes or no, ma? That is a policy they are followed in net operating income approach. Debt వచ్చింది అన్న, దాంతోపాటు రిస్క్ కూడా వచ్చింది. రిస్క్ వచ్చినప్పుడు ఓనర్ ఉండడుగా. ఓనర్ ఉండాలి అంటే వాడికి ఏదో ఒకటి చేయాలిగా. ఏం చేయాలంటే వాడి ఎక్స్పెక్టేషన్ ఆల్రెడీ 12% ఉంది. ఇప్పుడు డెట్ వచ్చింది కాబట్టి ఎక్కువ అడుగుతున్నాడు, లేదంటే వెళ్ళిపోతా. క్లియర్నా? నౌ వాట్ వీఆర్ డూయింగ్ మీన్స్, What are the advantage we are get due to the debt? We need to compensate to equity shareholder. For example, due to debt, the advantage is 2%. Nana clear Nana? How much extra asked by a equity shareholder? 2% only. Risk how much? 2%. They are expecting 2% extra. Advantage of 2 rupees, debt. Disadvantages 2 rupees, equity. What happened, Nana? KO, what happened? Same only. Minus 2 plus 2. Net effect how much? 0. That is a name called set of theory or offset. If KO constant, market value of firm also constant. If KO decreases, market value of firm increases. If KO increases, market value of firm decreases. If KO constant, market value constant. Net operating income approach. That is just a theory content. There is a no calculation part. Hope you guys clear about this net operating income approach. Okay, the meaning of set of theory. Okay, offset. Okay, okay, then fine. Now when it come to the next discussion, approach, Nana. What's the full form for approach, Nana? Modigliani and Miller approach. Are you okay? Now they are saying that David Duran, what you said is a right, but explanation is wrong. What you said is a right, but explanation is wrong. What is right means market value constant, right only. But what explanation you given? Offset to set off, na? No, that is not a reason. The reason behind that is investor mindset. What, Nana? Investor mindset. Company market value not based on capital structure, it based on investors. Hope you guys clear. If all investor ready to fit that company, market value what happen? Increases, huh? Decreases. But that bullshit guy David not consider that investor mindset. Hope you guys clear. Now they're rectified by two brothers, Modigliani and Miller. Nana clear? Huh? Okay then. So market value constant not because of offset theory, because of investor mindset. Now what happened means I have a two company shares, Nana. One company has two companies have a same value, 100 rupees, 100 rupees. X company, Y company. The share prices are 100, 100. So this is a unlevered firm. This is the levered firm. Okay. Now, due to some avoidable issues like scam, etc., here 3,000 crore rupees allegation happening in company Y. If allegations are came, share price what happened? Fluctuate or same? Fluctuate. What fluctuate? Increasing fluctuate or decreasing fluctuate? Decreasing fluctuate. Yes or no, ma? So everyone selling shares in which company? Y company. At that time only investor think with logic. So common sense, if it is a fall to 10 rupees, but I have a share at 100 rupees now in X Limited, here I will do selling, Nana. Okay. If I sells how much in my hand? 100 rupees. I will invest in a Y Limited now. For less investment, I will get a more number of shares. Hope you guys clear? Because of investment, Y company share price what happen? Decreases or increases? Now here I am selling, here I am investing. Pumping, it's called pumping. Clear? Because of selling, the share price fall to 100 to 90, 80, 70. Because of investment, the share price increases from 10, 20, 30, 40. At one point of time, what happened? Both are same prices only now. But here I have a more number of shares. Here I have a less number of shares. Nana, okay? So if it is a same means market value of firm is what, Nana? Constant only, na? This constant because of capital structure changing, not because of capital structure changing, because of investor mindset. Nana, clear, Nana? This is a theoretical explanation for approach. Here also calculation part is involved, Nana. The calculation part. Without tax, with tax. When it comes to the without tax, market value of unlevered firm, market value of levered firm. Two things you need to figure out. Now when come to the market value of unlevered firm, EA ESH divided by KE. Any doubt on this? How we get market value of equity? EA ESH divided by KE. When it come to here, EBIT divided by KO or market value of equity plus market value of debt. Same as what approach, right? The calculation same as what approach? Net income approach only. Are you okay? Now the one important thing is with tax model, Nana. With tax model. Now when it come to the with tax model, here also market value of unlevered firm, market value of levered firm. When come to the market value of unlevered firm, EA ESH divided by KE, EA ESH divided by KE. Now what students thinks about market value of levered firm? Either these two logics only, no? EBID divided by KO or market value of equity plus market value of debt. Student think that logic only, no? But there is a separate procedural calculation for with tax approach. That separate calculation part is market value of firm equals to what firm? Levered firm equals to market value of unlevered firm plus tax shield or tax benefit. Tax benefit or a tax shield. Now, market value of unlevered firm you already calculated. Yes or no? No? Market value of unlevered firm with the tax model you already calculated. Now, the tax shield is nothing but debt into tax rate. Debt into tax rate. This is a different procedural calculation for approach with the tax model market value of levered firm. Market value of levered firm. Nana clear, Nana? Very, very important, Nana, MCQ. Now, how to calculate EA ESH here? EBIT, where is interest? Unlevered firm. Which company it is? There is a no interest. Into 1 minus tax? No. Which model it is? Without tax model. Can I name it as EBIT is nothing but EISH? Hope you guys clear? Okay, then fine. Here also EAESH divided by KE, no? Market value of equity. Now what is the EAESH definition here? EBIT minus interest, huh? Why minus interest? Levered form. Levered means debt is there. If there is a debt, there is a interest. 1 minus tax, huh? No. Without tax. So EBIT minus interest is nothing but what, Nana? EAESH. Okay. Now what about EAESH definition here? EBIT minus interest, huh? No. What form it is? Unlevered form. Into 1 minus tax, huh? Why? With the tax model. Minus preference dividend, huh? Minus preference dividend, huh? Why? Two sources, equity and debt, divided by K. So now this is EBIT minus EBIT into 1 minus tax is known as EAESH. This kind of small things is important, Nana, in approach. Clear, na? So this is a calculation set by approach specifically. Clear? So generally student feels that tax advantage only for what, Nana? Interest. But this is a procedural calculation of levered firm. That's why they said specifically tax shield means definition is what, Nana? Debt value into tax rate. Debt value into tax rate. Not there in notes, huh? విత్ ట్యాక్సా? దానికి క్యాలిక్యులేషన్ పార్టే చెప్పాడు. నార్మల్గా మనం ఎలా ఫిగర్ అవుట్ చేస్తాం? మార్కెట్ వాల్యూ ఆఫ్ ఫర్మ్ అంటే ఎయిదర్ క్యాపిటలైజేషన్ ఈబీఐటీ డివైడెడ్ బై కేఓ చేస్తాం. ఓకేనా? లేదు అంటే ఏం చేస్తాం? మార్కెట్ వాల్యూ ఆఫ్ లివర్డ్ ఫర్మ్ ఈక్వల్స్ టు మార్కెట్ వాల్యూ ఆఫ్ ఈక్విటీ ప్లస్ మార్కెట్ వాల్యూ ఆఫ్ డెట్ చేస్తాం. క్లియరా? బట్ ఎంఎం అప్రోచ్ ఏం చెప్తుందంటే ఈ రెండు లాజిక్స్ కాదు, సెపరేట్గా వాళ్ళు క్రియేట్ చేశారు లివర్డ్ ఫర్మ్ క్యాలిక్యులేషన్ కోసం. సో ద క్రియేషన్ ఏంటంటే మార్కెట్ వాల్యూ ఆఫ్ అన్లివర్డ్ ఫర్మ్ ప్లస్ tax shield. This is a creation. Clear? So the tax shield, the definition they given, debt into tax rate. It's a creation thing, not a logical thing. If it is a logical thing, this is the right answer. Nana, clear, Nana? So enduku ilane chesaru ante the reason is they created the firm value based on this tax shield. Clear? Open illustration number 14. Illustration number 14. The following information is available about Blue Kite Limited. What is the meaning of NY, Nana? EBIT only, na? Okay. Tax rate is given, debt capital is given, interest rate on debt capital also given 8%. Now, capitalization rate applicable to the debt-free firm in a risk class, while which Blue Kite Limited belonging to 12.5%. Can I name it is called KE, Nana? Can I name it is called KE? What should be the value of the firm according to Modigliani and Miller approach? Now, as per information, this company Blue Kite Limited is there, na? Livered firm or unlivered firm, Nana? Why livered? That is there. Hope you guys clear? Now, as per MM approach, tax rate is there. Which model it is? With tax. Okay, then fine. Market value of livered firm equals to, how to calculate, Nana? Market value of unlivered firm plus tax shield. Now, how to calculate market value of unlivered firm? EBIT minus interest. EASH. For EASH calculation purpose, I am start from the EBIT into 1 minus. Why? Because unlevered firm don't have a debt capital, need not to deduct interest. Divided by KE plus, what is the definition for tax shield, Nana? Debt into tax rate. Now, what about the EBIT? 15 lakhs. 1 minus tax 0.4 divided by KE 0.125 plus debt value, Nana? 20 lakhs. On that 40%. What about the market value of unlevered firm? 72 lakhs. What about the tax shield, Nana? 8 lakhs. What about the Blue Kite Limited value, Nana? Sir, clear? So that's why I put it a 3-star for with tax market value of livered firm calculation. That is not same as what we learned. Sir, clear, sir? What we learned, either market value of equity plus market value of a debt or EBIT divided by KO. But the separate calculation part they provided for with tax model. What is the with tax model? Market value of unlevered firm plus tax shield. Are you okay? Next concept name, arbitrage gain calculation. This arbitrage, there is a 3 topics nana: arbitrage, hedging, speculation in the share market. Arbitrage, hedging, speculation. Hedging and speculation is a concept under SFM. I think this arbitrage related things also there, I think, in new syllabus. Not there, huh? No. Arbitrage theory is there, I think. Not started, okay. Arbitrage theory is there. So arbitrage, hedging, speculation. This is one of the concepts in traders is there now in a real world. They are buying shares and securities. For them, they know practically. Arbitrage, hedging, speculation. Okay, then fine. When it comes to the arbitrage, Nana, this is a company X, company Y, unlevered firm, levered firm. Okay. Now arbitrage gain saying that you can shift over from unlevered firm to levered firm or levered firm to unlevered firm, and the process, if you get any profit, that is called arbitrage gain. Less efforts, more benefit, Nana. Arbitrage represent less efforts, more benefit. Clear? Sir, how I shift, sir? Can I shift with flow? No, sir. You need to figure out return on equity for both the companies, Nana. What we need to calculate? Return on equity. Now the return on equity, you know, I think EA ESH divided by equity capital. EA ESH divided by equity capital. Now for example, here 13% is a return on equity, here 14% is a return on equity. Now which company providing you more returns? Which company giving you more returns to investor? X limited or Y limited? Then you can shift from X to Y. Everyone want more returns only, no? Sir, clear, sir? Okay, then fine. Return on equity 15%, return on equity 12%. Now, which company giving you more return? As per example 2. Then you can shift from levered firm to, that is nothing but Y to X. This kind of calculation not there in our final. Nana, clear, Nana? They provided only one problem. They said directly. Case 1, you are shifting from unlevered to levered. Case 2, you are shifting from levered to unlevered. Hope you guys clear? But when come to the reality, based on return on equity only we are shifting. Based on return on equity only we are shifting. Sir, okay na? Okay. When you were shifting, they provided 2 assumptions, Nana. They provided 2 assumptions. Assumption 1, if you are shifting from unlevered firm to levered firm, you are shifting from unlevered firm to levered firm, you have to follow this assumption. At that time only you will get gain. That is a point. Now what is the assumption means? If you are shifting from unlevered firm to levered firm, you need to invest on equity plus debt. You need to invest in which capital, Nana? Equity capital and debt capital. Because of investing in equity, you will get EAESH. Benefit that only, no? Because of investing on this debt, you will get what, Nana? Interest. This is assumption number 1. We are shifting from where to where, ma? Unlevered firm to levered firm. Now, assumption number 2. If you are shifting from levered firm to unlevered firm, if you are shifting from levered firm to unlevered firm, previously you were faced risk or not, Nana? Where you were? Levered firm means at that company have what? Equity plus debt. It means you faced what? Risk only, na? Clear, na? If you are facing a risk means you are capable or not for bearing a risk నానా. ఇన్ని రోజులు నువ్వు రిస్క్ బేర్ చేసావు, ఇప్పుడు కొత్తగా బేర్ చేయడానికి ఏమన్నా ఇబ్బందా నీకు? లేదు కదా. దానికోసం వాళ్ళు ఏం చెప్పారంటే, ఒకవేళ నువ్వు లివర్డ్ ఫామ్ నుంచి అన్లివర్డ్ ఫామ్కి వెళ్ళి అడుగుంటే ఎంతైతే నువ్వు లివర్డ్ ఫామ్లో రిస్క్ బేర్ చేసావో అంత డబ్బులు బయట అప్పు చేయి. నాన్న క్లియరా నాన్న? ఆ నువ్వు అమ్మేసిన స్టేక్ దానికి ఈ కొత్తగా తీసుకొచ్చే డెట్ క్యాపిటల్ యాడ్ చేసి ఇన్వెస్ట్ చేయి. ఇన్వెస్ట్మెంట్ విల్ వాట్ హ్యాపెన్ నాన్న? ఇక్కడ నాకు 10% ఓనర్షిప్ ఉండేది నాన్న, ఓకేనా? ఈ కంపెనీలో నేను ఒక 10% ఓనర్షిప్ ఉందంటే రిస్క్ కూడా ఎంత బేర్ చేసి ఉంటా? 10% రిస్క్ బేర్ చేసి ఉంటా. ఇప్పుడు వాళ్ళు ఏం చెప్తున్నారంటే, ఈ 10% నువ్వు అమ్మేస్తున్నావు కదా, ఇన్ని రోజులు ఈ 10% రిస్క్ బేర్ చేసావు కదా, ఇప్పుడు కూడా చెయ్యి. ఎలా? ఆ 10% రిలేటెడ్ అమౌంట్ బయట తీసుకురా. అప్పుడు నీ దగ్గర క్యాపిటల్ ఏమవుతుంది? 10% అమ్మడం వల్ల ఒక 100 crore రూపీస్ వచ్చింది. బయట ఒక క్యాపిటల్ తీసుకొస్తున్నావు కదా, ఫర్ ఎగ్జాంపుల్ 50 crore తీసుకొస్తున్నావు. Total amount in your hand how much? 150 crore rupees. Now this 150 crore you need to invest in which company? Unlevered firm. Because of that more investment you will get what nana? More return. More return is nothing but more EISH only na. These are the assumptions you have to follow when you are shifting from levered firm to unlevered, unlevered to levered. Sir, clear sir? I am telling once again, what is assumption number 1? If you are shifting from unlevered firm to levered firm, till date you are not paid any risk. Sir, clear sir? You are going to risk now. That's why put on amount, equity capital and debt capital, enjoy equity earnings and interest earnings. Previously you are in unlevered firm now, what earnings only you are enjoying? Equity earnings only. Because of investing in equity and debt, what are the earnings you are enjoying now? Equity earnings plus debt earnings. Okay, that is assumption number 1. What about the assumption number 2? If you are shifting from levered firm to unlevered firm, you already faced a lot of risk in the company. That's why you are capable. If you are capable, take such what are the amount you faced in an outside market. If you take an outside market, you need to pay interest or not, Nana? Yeah, I can. Sir, clear sir? Debt is cheaper only na. తక్కువ ఇంట్రెస్ట్ పే చేస్తాం, ఎక్కువ ఎర్నింగ్స్ దొబ్బేస్తాం. Are you guys clear? This is the assumption. Without this assumption, problems will not solve, Nana. Are you okay? Then open illustration number 15. Illustration number 15. Simple steps, Nana. First, find out the profit, how much you are earning in your existing company. Okay. Next, sell your stake. If you sell, you will get money now. If you invest that money in opposite company, how much percentage you will get? That is the third step. Step 1, calculate a return on your existing company. Step 2, sell your stake. Step 3, invest that money in other company. Hope you guys clear? If you invest, you will get a new stake, na? You will get new stake, na? Calculate that new stake. That new stake will generate equity earnings and debt earnings as per assumption 1. That is a step 4. Now compare step 4 new earnings and existing earnings. If it is a favorable, that is called arbitrage gain. Okay. Now see, consider the following information relating to the firm RIL and SIL, which are similar each other in all aspects excepting leverage. Okay. RIL company equity capital 1000, debt 0. Can I name it is called unlevered firm? Okay. Net operating income 100 lakhs. 100 lakhs. Can I name it is called EBIT for RIL? EBIT for RIL? Both. EBIT same, EIS also same. Why? No debt, no interest. Tax rate also not given. Tax rate is given, huh? No. You need not to pay tax. That's why EBIT is nothing but what, Nana? EISH. Okay. Interest on debt 0. Why? Unlevered firm. Market value of equity 2000. Sir, equity share capital 1000, market value of equity 2000. Why, sir? Equity capital 1000, market value of equity 2000. Why? I said clearly in a KO calculation market value. Equity represent reserves on surplus plus equity share capital. Nana clear? Capital is 1000. What about the extra 1000? Reserves on surpluses, collectively known as equity. If you have a stake means on which value? 1000 or 2000? Then మీద రైట్ ఉంటుంది నీకు క్యాపిటల్ మీదనా క్యాపిటల్ ప్లస్ ప్రాఫిట్స్ మీదనా క్యాపిటల్ ప్లస్ ప్రాఫిట్స్ మీద ఉంటుంది ఓకే దెన్ ఫైన్ కమ్ టు ద సిల్ నాన్న ఈక్విటీ క్యాపిటల్ 600 డెట్ 400 నెట్ ఆపరేటింగ్ ఇన్కమ్ 100 ఇంట్రెస్ట్ ఆన్ డెట్ 20 మార్కెట్ వాల్యూ ఆఫ్ ఈక్విటీ 1000. Sir, clear? Now tell me, what about that 100 EBIT? This 100 EBIT only, na? Can I name it is called EISH? But you said in a previous company EBIT is nothing but EISH. There is a no interest, sir. Here interest is there. Now EBIT is different, EISH is different. So out of 100 rupees, 20 is interest means what about the pending? 80 is nothing but EISH. This kind of clarity we need, Nana. Clear? Then fine. Case A. Show how an investor holding 10% stake in RIL can generate arbitrage profit by using a personal leverage. Where he had a stake, Nana? RL. Now he was shifting to, if you want to calculate arbitrage profit, you need to shift, na? Yes or no? You are in RIL, where you need to shift? SIL. Unlevered to levered. What is the assumption? You need to invest on equity plus debt. Okay. Case B. Forget about the case B now. First solve the case A. Now another point, Nana. What about the market value of firm of RIL, Nana? Market value of firm. Why 2000? So market value of firm is nothing but market value of equity, that is nothing but 2000. What about the market value of SIL, Nana? 1000? No. 1000 is known as what value? Equity value. Equity plus debt is known as market value of firm. Hope you guys understand. If you wrongly taken that values, solution is wrong, Nana. Market value of firm equals to what, Nana? Market value of equity plus market value of a debt. That means what, Nana? 1000 plus 400. 1400. You are investing on what value? 1000 or 1400? 1400. Clear, Nana? Okay, then fine. Step 1. Please calculate your existing company earnings. Written in SIL. SIL or RIL? You are in existing RIL. So equity earnings into stake. What is the equity earnings, Nana? Equity earnings. EBIT is nothing but EISH. EISH is nothing but equity earnings. How much? 100 lakhs. On that stake, how much you have? 10%. How much earnings you are enjoying? 10 lakhs in existing company. For comparison purpose. Okay. Then step 2. Sell your stake. Sell your stake. Market value of equity into stake. Market value of equity into stake. Stake means what? Ownership only, no? Now what about the market value of equity of RIL? 2000. On that, how much stake you have, Nana? 200 lakhs. If you sell your share, how much you will receive for your hand, Nana? 200 lakhs. Are you okay? Now you are putting this 200 lakhs in another company. Step 3. Percentage of stake if investor invest in which company ma? SIL. Are you okay? Now percentage of stake equals to how much you are investing on which capital? Nana, clear Nana? Now how much percentage stake you will get Nana? 14.29. They round off with 3 Nana. 14.3%. Sir, clear sir? Okay. See, proportion of investment. What about the equity capital Nana in SIL? 1000 on 1000 14.3%. What about the debt Nana? 400 14.3%. 143. What about here? 57 point round off corona round off. Okay, 57 so 200 lakhs. This is the way you distributed based on assumption. What is assumption? If you are shifting from unlevered to levered, where you need to invest? In equity as well as debt. Are you guys clear? This is not required for us, but understanding purpose I explained. Okay. Then step 4, calculate earnings in new company. That is nothing but what Nana? SIL. You are invested na? You have a right to get a profits. Now profit or benefit equals to EA ESH into 14.3% plus interest into 14.3%. Why? Because you are investing where and where? Debt capital as well as equity capital. That's why you have a capable to get a return of EASH and interest. What is the EASH Nana? 100? 80. 100 is known as EBIT into 14.3% plus interest how much Nana? 20 into 14.3%. 143 lakhs or 14.3 lakhs? 14.3 lakhs. In new company, how much you are enjoying? 14.3 lakhs. In existing company? What is the gap? Because of shifting from unlevered to levered, how much gain you are enjoying? 4.3 lakh. That is called arbitrage gain, Nana. That is called what, ma? Arbitrage gain. Hope you guys clear? KCA. Now see the solution also there. Estimation of arbitrage profit if investor shifting from real to SIL. First I calculated profit on real, existing profit. How much, ma? 10 lakhs. Next, amount in hands of investor after selling his stake in real. How much stake they have, Nana? 10% of owner's fund of 2000 lakhs. How much? 200 lakhs they get because of selling of the stake. Next, Nana, percentage of stake if investor invests 200 lakhs in where, Nana? SIL. Now percentage of stake equals to investment amount divided by market value of SIL. Now how much you are investing? 200 lakhs. What about their market value? Market value of firm 1400 lakhs. How much percentage you will get a stake? This 14.3 had a two rights, equity right as well as debt right as per assumption. So this is a proportion of investment. Return on SIL, interest plus equity earnings. Now 14.3% on 20 lakhs, 14.3% on 80 lakhs. Total, here point is there, Nana. 143, not 14.3. 14.3 lakhs. Now arbitrage gain equals to return on new company minus return on existing company. What about the return on new company? 14.3 lakhs. Return on existing company? 10 lakhs. extra benefit I received 14.3 lakh because of shifting from real to SIL. Arbitrage gain. Okay. Now case 2 you need to give a carefulness, Nana. The reason they changed the market values. See case 2. Show how an investor holding 10% stake in the equity of SIL can generate arbitrage profit assuming that market value of SIL is 2000. Market value means market value of equity plus market value of debt, both. Are you guys clear? Then release 1000. Here need not to specify equity plus debt. Equity is nothing but firm value. Okay. That point very important, Nana. So real SIL market value of firm given 1000. 1000. What about SIL? 2000. Okay, then fine. I want market value of equity. So this 1000 is nothing but market value of equity. Unlevered firm. What about the SIL, Nana? Out of 2000, company have a debt of 400. If you remove this, you will get what, Nana? 1600. Clear, sir? If you want to sell SIL stake means where you need to sell? At 2000 or 1600? SIL lo stake అమ్మేయాలి. ఓనర్షిపే కదా స్టేక్ అంటే. దేంట్లో అమ్మాలి? 1600 లోనా 2000 లోనా? 1600. So if wrongly sell in 2000, problem is wrong. Why? Because the 2000 is what, Nana? Market value of firm, not market value of equity. Clear? Okay, then fine. Same steps only, Nana. Step 1. Existing profit. What stake you have? Equity plus debt or only equity? SIL. Stake means equity only. Yes or no? No. What right you have? Equity earnings and interest or only equity earnings? Only equity earnings. Clear up? Now equity earnings into what rate, Nana? 10%. What is the equity earnings? In additional point they not mentioned any earnings changes. That's why consider above. 80 into 10%. Existingly I am enjoying only how much, Nana? 8 lakhs. రిస్కీ కంపెనీలో నీకు స్టేక్ ఉందంటే దేంట్లో ఉన్నట్టు, నాన్న? ఓనర్షిప్ ఉన్నట్ట, డెట్ మీద కూడా ఉన్నట్ట? ఓనర్షిప్ ఒకటే కదా. సో ఓనర్షిప్ ఒకటే ఉందంటే నీకు రైట్ దేని మీద ఉంటుంది? ఓనర్స్ అర్నింగ్స్ మీద ఉంటుందా, ఈబీఐటీ మీద ఉంటుందా? ఓనర్స్ అర్నింగ్స్ మీదే ఉంటుంది. హౌ మచ్ ద ఓనర్స్ అర్నింగ్స్? 80 lakhs. వై? బికాస్ 20 lakh ఈజ్ ఏ ఇంట్రెస్ట్. క్లియర్, సార్? నెక్స్ట్ మా వాట్ అబౌట్ ది స్టెప్ 2? सेल करो. 1600 మార్కెట్ వాల్యూ అయితే దానిలో 10% నా స్టేక్ 160 lakhs. నాన్న క్లియర్ అన్నా? వాట్ ఈస్ అజంప్షన్? ఇఫ్ యు ఆర్ షిఫ్టింగ్ ఫ్రమ్ రిస్కీ ఫర్మ్ టు అన్రిస్కీ ఫర్మ్, యు ఆర్ capable to risk bearing. That's why you can take a loan from outside. How much your paid risk, na? 10% only, na? Now outside capital equals to company have a debt how much? 400 lakhs, sir? On the 10%, 40 lakhs. Now total amount in your hand 200 lakhs. Where you are going? Unlevered firm. Percentage of stake 200 lakhs. What about their market value? 1000. How much percentage now I can enjoy? 20% I can enjoy now. Sir, clear, sir? Now then step 4, calculate new earnings. How much portion, how much stake I have? 20%. What about the company earnings? 100 lakhs, sir? Real earnings. మొత్తం 100 lakhs మీద నాకు ఉంటుంది కదా, రైట్? వై? బికాస్ నో డెట్. హౌ మచ్, సార్? Can I enjoy this entire 20 lakhs? No. We take an outside loan. For them, you need to pay what, Nana? Interest. Out of this 20 lakhs, you need to reduce interest. How to calculate interest, Nana? How to calculate interest? Any rate is given in the question paper? Any rate is given in the question paper? Rate is not given, but clue is there. Interest amount 20 lakhs, debt amount 400 lakhs. What is the interest percentage? 20 divided by 400. 5%, na? How much loan you taken, Nana? 40 lakhs into 5%. How much, no? 2 lakhs. After payment of interest, you will get a new earnings 18 lakhs. Previously in SIL, how much you were enjoying, Nana? 8 lakhs. Newly you were enjoying? What about the gap, Nana? 10 lakhs. This is called arbitrage profit. Are you understand the assumption? Sir, clear, sir? Why I get this much of 10 lakhs means because of I taken what loan, Nana? Outside loan. Why I am taking outside loan? Previously I am a risk taker. Now also I am continuing with that risk. Purely assumption based. Clear? This is a very important question we have in arbitrage. Only one problem is there. Any doubts regarding this? Anyone? Any confusing point is there? Clear? Okay. As well that market values are changed in case 2. If you apply stake on that 2000, wrong answer. Why? Because the 2000 includes what and what? Equity plus debt. But I have a stake only on equity. That's why 160 lakhs into 1600 lakhs into stake 10%. Clear? Okay. So this is about capital structure related problems, Nana. See, I mentioned working note also clearly. Market value of equity 2000. Out of that, debt value 400. Now market value of equity equals to 1600. Clear? So if you not practice this problem, seriously you will miss అయిపోతాయి. Maybe చాప్టర్ 1 నుంచి వచ్చేదానికి ఛాన్స్ ఈ క్వశ్చన్కే ఉంది. ప్రతి అటెంప్ట్ గెస్ట్ లిస్ట్లో ఉంది కానీ రావట్లా. Sir, okay now. Only one problem is there. One small problem is there. I put it in additional questions, self-practice questions, small question. So the next concept, I hope you are the strong in this area. That's why I am taking this time value of money. It's not a concept. The next concept is price valuation. Okay, just for revision purpose. The time value of money concept is involved in price valuation and the revision కోసం తీసుకున్న ఈ కాన్సెప్ట్ ఉంది 7 minutes ఉంది. Okay, then fine. I hope you know the concept of time value of money. What does it mean for time value of money? Today rupee is not same as tomorrow or future rupee. Yes or no? No. The reason? Rupee has a value. Nana clear, Nana? Currency point of view not changes. Value point of view changes. Same Gandhi Data, same 500 symbol. But what changes? Value changes. Hope you guys clear? Now, here we are using two concepts called discounting, compounding. Discounting and compounding. Now there is a classic example in one interview I seen about the Allu Arjun. In that entire their Allu Arjun family, in child age, he was only the person don't have any goals in the future. At the time of a small kid, his grandfather feels that in future మనోడు దేనికి పనికిరాడు. Seriously, మనోడే చెప్తాడు ఆ విషయం. See, he invested 10 lakh rupees in some 25 or 35 years ago for future purpose. Nana, clear, Nana? Now, for example, here it is called Allu Ramalingaya Garu, here it is called Allu Arjun. Are you guys clear, na? If Allu Ramalingaya need to know how much Allu Arjun will receive in future, understand the point? He put at 10 lakh rupees, but you need to know the maturity value. Guys, clear? Now the traveling time is known as compounding. The traveling concept is known as what, Nana? Compounding. What we do means, for the 10 lakhs, every year they will add what, Nana? Interest. Sir, clear, sir? Now when it come to, if second question, Allu Arjun need to know how much his grandfather deposited. He knows 10 lakhs, but for example he don't know. At that time, what he need to do means, he will get some bulk amount, na? That is called you need to do what, Nana? Discounting is nothing but for that bulk amount you need to remove interest of every year. If you remove every year interest on that bulk amount or maturity amount, what you will get, Nana? Discounting value. This is nothing but present value. This is nothing but future value. This is a calculation of present value and future value. Sir, clear, sir? We have a formulas and calculation tricks also. Okay. But when come to the Spm&Bv, this much of discussion is not required. Just present value factor calculation, present value of annuity, regular factor calculation. These two things is needed, Nana. Sir, clear, sir? If there is a single transaction amount, that is called, at that time we are using present value factor. If there is a same amount, same interval for noun period, that is called annuity. That is called what, Nana? Annuity. For that annuity, we can use individual year discounting, or you can also use a shortcut. You will get same answer or both. So when it comes to the present value factor calculation, so there is a classic calculation called present value equals to future value into present value factor or percentage n number of years. Nana, clear, Nana? Now, this present value factor calculation 1 divided by 1 plus r power n. Sir, clear, sir? With the help of this formula, you can figure out present value as well as future value. Shuffling of the formula, no problem. Okay. Now, the present value factor calculation formula is what, Nana? 1 divided by 1 plus r power n. Okay. Now, we are not using the calculation. We are using a concept of calculator steps. So, take 1 divided with 1 plus r equals to n times. This is a way to calculate present value factor. Nana, clear, Nana? Any doubt on this? For example, I want future value. If I shuffle this, what happens, Nana? Present value into future value factor or percentage n number of years. Now that future value factor purpose, there is a calculation 1 plus r power n. Here also we are not using formulas. Here also we are using calculation tricks. The calculation trick is take r, add 1 into 1 equals to n times. If you want 5, press 5 times. If you want 6, press 6 times. If you want 3, press 3 times. That is called n times. Nana, clear, Nana? Any doubt on these two calculations? Okay, then fine. Next, when it comes to present value of annuity. What is the meaning for annuity? Same cash flows or same amount for n number of years, not indefinite life. N number of years, either 10 years or 20 years or 5 years or more than 1 year. Sir, clear, sir? As well, there is a no interval break. Every year need to be continue. Sir, clear, sir? At the time, instead of this present value trick, we are using present value annuity factor trick, Nana, for direct answer. Now, what is the trick means? Take 1 divided with 1 plus r equals to, you will get first year. Are you guys clear? Again press equal to, you will get second year. Again you will press equal, you will get third year. I don't want individual years. I want sum of years. Nana, clear, Nana? For that purpose, equal m plus. Equal m plus, that value will save in your calculator. Are you guys clear? If you want 5 times, equal to m plus 5 times. That is nothing but equal to m plus n times. Are you guys okay? Next, you need to press GT or MRC. Depends on the calculator. Now, what are the values you saved in memory due to m plus that will give a grand total? That is called what, Nana? Present value of annuity factor. Sir, clearer, sir. In annuity also there is a concept, Nana. Annuity regular, annuity due. That much of discussion is not required for Spm&Bv. That is required for SFM. Are you guys clear? So for our purpose, we need these three concepts. Even before saying the name concept, just I want these tricks to calculate. That's it. Are you okay now? How to calculate present value factor? 1 divided by 1 plus r equals to n times. How to calculate future value factor? R plus 1 into 1 equals to n times. How to calculate present value of annuity factor? Sum, that is nothing but 1 divided by 1 plus r equal to m plus n times GTR MRC. This is about time value of money knowledge required for Spm&Bv. That's it. Are you okay? Okay, thank you.